Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Monday, August 25th. The stock market started the week on a sharply lower note and the lightest trading volume of the year. Overall, it was a slow news day, although there were several negative headlines out of the financial sector. Trading volume was very light, with only 865 million shares exchanging hands at the NYSE, so it is not clear how much conviction was behind this session's move. Still, buyers showed little interest, considering that 95% of stocks within the S&P 500 posted a loss. All 10 economic sectors declined at least 1%. Although weakness was widespread, the financial sector, which dropped 3.1%, took the brunt of the selling pressure. Shares of Dow component AIG fell to their lowest level in 13 years after the company had its third-quarter earnings estimate cut to a loss of 86 cents per share at Credit Suisse. The insurance giant also had its credit ratings placed on a negative watch at Fitch Ratings. Lehman Brothers struggled after South Korean regulators told the Korea Development Bank to take a cautious approach before making an acquisition of an overseas bank, according to the Financial Times. The state-run bank reportedly expressed interest in Lehman Brothers during the previous week. Regional bank Columbian Bank and Trust Company was closed by banking regulators over the weekend. Although the bank only has $752 million in assets, it is still a reminder that more bank failures are a real possibility. Only 3 of the financial sector's 89 components posted a gain. Freddie Mac's $2 billion debt offering received increased interest from investors, sending shares of the struggling government-sponsored enterprise sharply higher. Fannie Mae rose in conjunction with Freddie Mac. Bond insurer MBIA, meanwhile, rose on no specific news item. Other sectors that posted large losses include consumer discretionary, which was down 2.4%, materials, which fell 2.3%, and telecom services, which declined 2.2%. The defensive-oriented utility sector, down 1.1%, outperformed on a relative basis, benefiting from a rally in the long end of the Treasury yield curve, where the 10-year note climbed 23 ticks and the 30-year bond gained 38 ticks. The energy sector, down 1.5%, also outperformed on a relative basis, after crude oil prices posted a modest gain of 0.5% to $115.12 per barrel in volatile trade. In economic news, the National Association of Realtors' existing home sales report for July was mixed, but provided signals that a bottoming process in housing is taking shape. The number of home sales rose by a larger than expected amount to 5 million units on an annualized basis, while home prices declined and the amount of unsold inventory rose to the highest level since at least 1999. Existing home sales are down 13.2% year over year, but were up 3.1% versus the prior month. The inventory of supply of unsold homes was at 11.2 months compared to the 2007 average inventory supply of 8.9 months. The inventory of single-family homes, however, improved to 10.6 months supply from 11 months, which indicates that falling prices are helping to stimulate demand. The median sales price fell 1.3% month over month to $212,400 and is down 7.1% compared to last year. I'm Pat O'Hare for Briefing.com. Thanks for listening and have a good evening.